Kathleen, there has been a staggering $40 billion of M&A in warehouses this year alone. 40 billion, more in fact than $40 billion. And you and your partners at Blackstone have been responsible for more than half of that, about $25 billion. Prologis is right behind you at about $15 billion. What is the investment thesis that has driven all that buying and made Blackstone the world's largest owner of warehouse space?
Well, hello. It's really nice to be here today and be here with these two gentlemen. Our business is a high conviction thematic investment business. And so what we try to do in all of the areas in which we invest is to look out at the world and say, what is happening and how do we translate that into a real estate concept that we think can be successful for our investors. And the theme that's really driven all of the warehouse investing really for the last decade, when we've bought about 1 billion square feet of warehouses around the world, is that we see a share shift happening. We see e-commerce as a really powerful driver in the change in how goods are delivered to the ultimate consumer, whether that's a human being or a business. And so we have just tried to follow that and lean into that trend as we see that shift happening.
Brad, what Blackstone does is effectively buy boxes. You put stuff inside the boxes. It's a little more complicated. Tell us about your business. Who are your clients? What does XPO do for them?
Okay. First of all, thank you for inviting us here. We appreciate it very much. Thank you for your interest. So we're in the business of moving goods for our customers through the supply chain in the most efficient way. So that can be by air, that can be by sea, that can be by truck, that can be by rail. And in between, it goes in a warehouse. So while Kathleen owns 800 million or so of square feet of warehousing, we lease about 200 million square feet of warehousing. So,
including some Blackstone space.
Yes.
Yes, we're a tenant.
We're glad to have them.
Very good landlord.
We'd like to have more.
And you'll get more. So the drivers of our business are e-commerce, growth in the economy in general, and outsourcing, and technology. So the whole thing that's driving the growth in logistics is increasing technology. It's information, it's gathering information, where customers have goods, where they got to go, and what's the best way to get them in the most time-efficient way. And the companies that have the best technology, the best AI, are the ones who win in this space. So that's why we have 1,800 full-time technologists on staff, including 100 big data scientists.
And you do this stuff for Verizon, Nike, Nestle?
Most of the Fortune 500.
One of the aspects to the logistics industry that I was previously unfamiliar with, and which I want you to explain a little bit of, is reverse logistics. Mm-hmm. What is reverse logistics? So
in e-commerce, you don't know exactly what size you are in that brand, so you buy a size 9, 9.5, and a 10, and then you send the 2 back that don't fit. So roughly speaking, about 20% or so of all e-com orders get returned.
20%?
Roughly, about 1 out of 5. And so we handle almost 200 million units a year of returns. And
on behalf of those?
Behalf of the customers, yeah.
So, and correct me if I'm wrong, I or anybody else in this room goes to Nike.com, decides to buy a pair of sneakers. After I press that button and pay for it, that's when you take over?
Nike doesn't use us exclusively for the forward logistics, so we do have a good amount of forward logistics with them. We do run rebound for them, what they call rebound.
Okay, so if I decide I'm going to return, a couple of pairs of sneakers,
that's likely to come to us in Indiana, and our job is to get it back into the supply chain. And we've taken the time to get it back in down from 5 days to 1 day. And that's all based on technology.
Kathleen, I want to look into the near future, and then I want to look a little further ahead. Tell me, what do you see as the dominant trends shaping logistics, and in particular, your side of the logistics business over the next couple of years? And what do you think is going to happen over the next 5 years, over the next 10 years?
So as Brad's talking about, really technology is transforming everything, and obviously this is the underlying thesis. And I'd be curious in this audience, how many of you today, while you're here maybe, have ordered something online? Anybody? You can admit it. I know. Yeah, there's good apps. And are you hoping to get that by the time you get home from this conference is like the big question, because I think what we're really seeing is the effect of people wanting their goods faster. And Brad and I were having a chat about whether people really need them faster. I'm not always
Instant
sure we do.
gratification.
Instant gratification. Yeah, I talked with my children about needs versus wants. In this case, it's people want goods faster. And this press for same-day delivery or even delivery within a few hours is really radically transforming the demand for warehouse space, particularly in the most infill locations in the densest population centers. And so we have pivoted our business to follow the tenants where they want to be. So I think about over the last decade when we have been investing in warehouses, really what has happened is the locations of our warehouses have moved closer and closer to the densest population centers around the world. People call it that last mile or that last touch location. Where is the last stop for a good on its way to the ultimate consumer? And I think that is going to continue to be a really important trend to follow, is just how tenants want to be in the spaces closest to where the end consumer is, and how that's actually where there is the least new supply for warehouse space.
Do you see the same?
I do, which is why we launched XPO Direct about a year and a half ago, which allows customers to share our footprint. So the old model was you had a warehouse or distribution center in the West Coast, in the East Coast, and one or two in the Midwest. The new paradigm is, as Kathleen was just saying, you want to get it closer to the customer. And so we went to our customers and said, well, why don't you just put your inventory in our network? And we'll use our predictive analytics, our AI, to help customers know how much inventory is not too much, not too little to put where. And the time for fulfillment is cut in less than half as a result of that.
Can you measure what that saved them in cost of carrying inventory, time to delivery?
It certainly saves on inventory costs, carrying costs. With interest rates so low, that's not the main factor, although at some point in the cycle that would be a more important factor. It's what Kathleen was talking about, the need for fulfillment in a quicker way. People order things and they want it soon.
I'd also say, and I think Brad can probably comment on this more knowledgeably even than I can, but when we look at the cost of a retailer's, let's say, supply chain, really the real estate is a relatively small portion of that, and that's part of what has supported rising rents in the most infill locations. Transportation and labor costs are a much bigger part of their kind of the cost structure, and so again, this press to be closer and for Brad, to utilize Brad's services closer to where the goods ultimately are going to be is also a way of managing the cost as they think about the overall pie.
So it's not entirely up to you, but if you cast your eyes 10 years forward, do you think there'll be anybody working in your warehouses?
So, I'd say there's always room for human ingenuity, and I think there's, good management and leadership matters everywhere, including in warehouses. But I think, Brad can probably comment more effectively on, what is happening inside the box. Really, our greatest service and the value that we bring to our tenants is to find great locations and functional spaces, great spaces where they can do what they need to do to automate and optimize what they're doing with their products.
The trend is definitely towards more automation, more productivity.
Robotics?
Robotics for sure. In the UK, we have a joint venture with Nestle to create the warehouse of the future. And it'll be about the size of 10 football fields, and it'll handle about 1 million pallets a year. And it'll have 30 people in each shift. So it's a very highly automated, very efficient, and that's where the world is going. That's the future.
30 people a shift?
Yeah.
On 8-hour shifts? Or?
Yeah. So about 100 people in
over the
total
course of 24 hours?
Yeah.
What would that have been 10 years ago, 15 years ago?
It would have been 1,000.
1,000?
Yeah, because productivity has gone way up even before robots and cobots. Productivity has gone up just by being more aware of what's going and what's moving from where to where, and then applying that information to the logistics of it. Logistics is the cornerstone of what makes a successful OEM, what makes a successful retailer, what makes a successful e-com player. It's the logistics. It's the connecting. It's gathering the information of where things are and how do you get them to where they need to go most efficiently. That's the key.
So the warehouse is effectively ground zero for robotics, for the implementation of artificial intelligence. What does that mean for your business? You employ 100,000 people. Labor, if I understand it correctly, is the single biggest line in your P&L.
About $6.5 billion.
$6.5 billion a year. So surely all things being equal, at least on a relative basis, those numbers are both way lower 10 years from now.
They'll come down. We're investing in the employee base. We've had 2.4 million hours of training for our workers just year to date, so we'll top 2.5 million hours by the end of the year, and making it a safer place for those workers, making them, so robots and cobots, robotic arms, they're not all bad for the workers. It's actually positive for the workers because you have less injuries, you have less accidents, you don't have to walk miles all during the day, there's less stress, there's less strain. It is a symbiotic relationship.
Anyone who's listened to someone from Blackstone speak about the advantages to their business model has heard about scale. You're both big believers in the importance of scale.
Oh, of course.
Why is scale important from your point of view, and then Brad, why is it important from yours?
Well, I think scale is powerful for us for a couple reasons. One, I would say just access to information and data, and I'm sure Brad will talk about this too. The more property we own, the more places in which we're operating, the more data points we have on what's actually going on in our business and in the businesses that we lease space to. And that is a very powerful information advantage that helps us inform our strategy in terms of new acquisitions and also inform how we drive value creation in the assets we own, and also ultimately, how and whether we sell assets we own. It's just data and information is really power. And I'd say as our business has expanded and moved around the globe, and actually technology has really enabled more automation of that data, we feel it's become a more and more powerful tool to us. The other thing that's so powerful about the scale of our capital and of our team is just the nature of the transactions we can compete for. And so in a world where prices feel a little full, and there are plenty of people who would love to own warehouses. It's no secret. We're on this panel for a reason. Our scale has really differentiated the types of transactions that we can position ourselves to do. And this year's been a perfect example. We didn't set out this year to buy 25 million square feet of warehouses, but there were a couple of very, very sizable situations where owners of great portfolios needed to exit. And we were able to have very little competition in positioning ourselves to buy those assets. And that just allows us to generate better returns for our investors.
Scale has a lot of advantage in most industries, including ours. Scale gives us the ability to be not just the quality leader, the service leader, but also the cost leader. So all of our customers have the same pressure. They have wage inflation, they have cost inflation in general. They have to find productivity to overcome that. They have to find more productivity than the inflation part. So they're looking to us to take costs out. Now, scale gives you the ability to spread out all kinds of centralized costs over a bigger revenue base. So you can spread your SG&A out over everything. You look at the tech group. So the tech group, 1,800 full-time tech people. We couldn't do that if we were a small company. We couldn't spend $550 million a year on innovation, on technology, if we were only a $550 million company. So there's a lot of advantage. You attract the best talent. So we have the largest e-fulfillment platform in Europe. So we see pretty much every single RFP there is in e-commerce in Europe as a result of that.
One of the things that having scale enables you to do, particularly in technology, is to invest in future technologies. And I like when you talk about the future in what you describe as cosmic terms. I want you to get cosmic on us. If you look out 10 years ahead, how is the logistics landscape going to be transformed? What will be there today that, then that isn't there today?
Faster, cheaper, less inefficiencies, of which there's a lot, less waste, of which there's a lot. If you look today, even in here in the United States, there's about 3 million Class 8 trucks on the highway. And they're all in the wrong place. They're about 20–25% underutilized, which means the space that's in all those trailers in aggregate is about a quarter empty. Well, that's not efficient. That's just totally inefficient. The reason that takes place is because there's no central place where you can just log on and see where all those trucks are. There's these silos of trapped information. That will be unlocked. And then there'll be more efficiency as a result of that. That's a huge cost out of the economy.
What about all the things we hear are going to transform the logistics business, like autonomous trucking, 3D printing, you know, Jeff Bezos' famous drones.
Autonomous trucking absolutely is coming. There's no question about that. Within 10 years, there'll be fully autonomous trucks, fully level 5 on the highways. That'll take cost out. It'll take huge cost out. That'll help with what I was just talking about in terms of getting more efficiencies, because everything will be machine to machine instead of human to human to human. It'll be machine to machine, and the 3PL will be in the middle of that. So it'll be a good business, but a very different business than it is right now. The big trend in the nearer term is AI. AI we can use for pricing. We can use that for figuring out better than the customer can figure out what their peak season is going to be, because we have their data, but we also have all their competitors' data. So we're in the market with all that data. So AI helps us take that data and then serve the customer with information that they really can't get on their own.
Kathleen, I mentioned Jeff Bezos, not by accident. You know, Amazon is clearly the elephant in the room.
Yeah.
From your perspective, what has the Amazon effect on logistics been?
Yeah, I think Amazon in so many ways has kind of set the pace, if you will, literally and figuratively, right? They, with Prime and same-day delivery, they, if you will, created a preference among consumers, and this is what we were talking about before. Do people need things the same day? Well, maybe or maybe not, but that's when they want it, and now someone has shown them they can have it. And so I think Amazon has really driven an acceleration of, you know, how fast goods are moving to consumers. And, you know, as it relates to our business, it really has driven more of this demand into these infill and last mile locations. And we see, you know, same thing, we look at our tenants and we look at Amazon and others and we say, well, what did their footprint look like 10 years ago versus what does it look like today? It's moving closer and closer into cities because of that speed up in the pace of delivery times. And Amazon has really led others to kind of follow that trend.
What are the pros and cons of doing business with an Amazon?
So I would say we see pros in working with all of our tenants, and certainly the larger tenants, you know, as they should. The largest service providers are going to drive different kinds of demands, maybe than a smaller player. But just like Amazon's, you know, keeping other retailers on their toes in terms of figuring out how they need to transform their own businesses to meet the demands of the consumers that Amazon's been able to do, we have to be able to make sure we're keeping up with an Amazon. And so I think it's all, you know, pretty positive. You know, our tenants make sure that we are responding to their needs, and that's really our job as their partner.
You've seen this firsthand, Brad. Amazon's a customer of yours, but Amazon can turn on a dime, right, and bring things in-house, and all of a sudden, the demand for your services evaporates in the space of a quarter. Is it a given that you have to do business with Amazon? And if so, is there a level of business that because of these risks becomes too great a risk?
Amazon's a good customer of ours. It used to be a bigger customer. It used to be a $900 million customer. It's about a $300 million customer now. I like them being a $300 million customer more than when they were a $900 million customer. It's more level playing field.
Yeah, but that's my point, right? Not everybody would say that.
I would say that. I would say you really don't want a concentrated customer base. So our top 5 customers today are about 6-7% of our revenue, with no one being more than 2%. I like that. That's a nice balance.
We talked a bit about warehouses, infilling, clustering is another phenomenon. It has been one of the contributors to an increase, right, in particularly in rents at warehouses in large, dense cities. How sustainable is that? How much of that is demand-driven? How much of it is supply control?
Well, I'd say both are always playing hand in hand. You know, you think about the fundamentals of real estate, it really is in so many situations just about supply and demand. And this is part of what has also, you know, the supply side of it is part of what has attracted us to these more infill, dense population centers, because we see, you know, asymmetries in terms of the amount of supply that's being added, which is almost nil in many places, versus the amount of demand which we see accelerating. And so that's part of why you've seen rents rising. And I'd point to what we were talking about earlier in terms of sustainability of tenants being able to take those kinds of spaces, pay higher rents. We see that as a good trade for them as they think about the cost of their overall supply chain in terms of closer locations allow them to reduce transportation costs, and is still, I think, a very good value as compared to a more traditional format of retail.
One of the things that I learned about Brad's business in the minutes before we took the stage here is that XPO has a pretty sizable real estate portfolio of its own, correct?
That's right.
About how much space?
Oh, we have about $1 billion of real estate that we own here in the United States, and about $100 million of real estate that we own in Europe. And it's kind of just trapped inside of the company that we acquired through acquisitions. Someday we're going to have to figure out how we unlock the value on that, because we don't get any credit for it.
So Kathleen can help us answer this question.
She might help us unlock the value at some point.
If XPO trades at 8 times EBITDA and industrial REITs trade at 25 times EBITDA, is the answer that simple?
For Brad, you mean?
Yeah.
In terms of, well, again, I think Brad's got to drive performance in his business. And if owning a lot of real estate is not additive to that, I think we'd be very happy to have a conversation about how we can help.
You'll all share in the finder's fee. We've talked about some of the things that are going to enable logistics to accelerate, and reduce cost and reduce time of delivery. Where are the bottlenecks? Where do you see the bottlenecks?
Oh, but in transportation, everything goes wrong all day long. So, trucks show up to the wrong place. You thought you were supposed to go to Columbus, Missouri. You went to Columbus, Illinois. You thought you should have a 53-foot trailer. You don't have a 28. So it's because of the inaccuracies and the fallibility of information sharing. So the more that can be automated, the more that can be done by technology, the error rate goes down quite a bit. It all comes down to data. Everything is about data in our business. It's about where things are, where they got to go, how's the best way to get them there. And when there's trapped information, that causes the bottlenecks.
Any bottlenecks in your business, or maybe a challenge is the better way to phrase the question?
Yeah, I mean, I would say we always believe when we buy real estate that there's an opportunity to operate it better. And in most of the time, the way that plays out in a real estate context is by occupying more square feet, by offering a better package. I talked about how functional is the space. There's some capital expenditures we can make and make it better. And certainly if we're not doing that work and keeping up with that, and like I said, keeping up with our tenants and the nature of their demand, we could have a bottleneck. But I think so far we feel really good about what we've been able to do in terms of delivering a great product and not having too many bottlenecks that would hold us up from being able to create value for our tenants and for our investors.
I think of Blackstone's interest in and subsequently ownership of warehouses on an enormous scale as a play on the internet-enabled economy. Where else can your firm play on the internet-enabled economy?
It's a great question. We are leaning into technology all over the place in our investment strategies. I think a great example of it is what we've done in life sciences. It almost started as a story on the real estate side of our business. I don't know how much you all know about the office market, but historically, offices that really catered to biomedical or life science tenants were not in favor. People had a lot of concerns about the cost of building them and whether you could ever replace them with more conventional tenants. And we looked at the world a few years ago and said there was a change happening, really enabled by the life science revolution, that was going to make the life science office space in greater demand than traditional office space. And we bought a nearly $9 billion company called Biomed. And that has really enabled us to participate in the growth and capital being invested in life science companies. And we've now been able as a firm to extend that directly into a life science investment strategy where we have a team that partners really with drug companies in order to help them bring drug concepts and molecules that are in trials to life. And it is really exciting to be part of that. And I'd say that's all, again, driven by technology. Additionally, when we think about office investing more broadly, we're really focused on innovation cities or knowledge centers. Almost all of the places where we've bought office recently, and certainly where our rental housing investments have been concentrated, are in the cities that are getting more than their fair share of population and job growth. And so much of that is driven by where the technology and where the media companies want to be. So it's like the west coast of the US and Vancouver. Think about northern European cities like Stockholm or Berlin, and in Asia it's places like Sydney and Shanghai and Melbourne. And I think our whole business is trying to pivot to where is technology changing things and how can we capitalize on that to drive performance for our investors.
Brad, Silicon Valley is trying to break into your business. Uber Freight, for example, is getting into the trucking business, so is Convoy. My understanding is that they're pricing some, if not more than some, of their services below cost. It's unprofitable. Didn't WeWork teach us that that business model doesn't work anymore?
I don't know. I'm going to take a contrarian view on that. So yes, there's a lot of bear theses about the digital startups, and they're losing money, and they're leading with price, but they're energetic, they're dynamic, they're thinking big, they're thinking out 5-10 years, not just thinking about the next quarter. So I think they're going to succeed. I think their business models will change because, yeah, long term, you have to make money in business. That's the whole purpose. Otherwise, capital doesn't come in. But I think they're here. I think they're onto something. They're not sleepy. They're very dynamic.
Last question for you both. The trade war with China, which may or may not get resolved depending on who knows any longer, has made companies, this goes without saying, you've heard it across industries, has made companies reevaluate where they source components, where they do manufacturing. Do either of you see, through the lens of your businesses, that shift happening? Is the shift in supply chains actually taking place?
For sure. You've seen over the last year sourcing go from China to Malaysia to Vietnam, even over here to Mexico. It's absolutely been displaced. And you've seen a general slowdown of, because manufacturing is a global economy that the proverbial is correct, that you tickle it here, it laughs over there, you pinch it here, it cries over there. So that's just slowed down. The whole tariff situation has slowed down the whole industrial economy here and in Europe. But despite that, in our third quarter, our main industrial levered business is less than truckload, LTL. We had our best third quarter ever in there. So there's ways to adapt to various situations. If you're agile, if you're entrepreneurial, if you're flexible, if you're smart, if you use technology, that you can still do well in that kind of environment.
You have a global footprint. What are you seeing?
Yeah, I'd say we have a much more limited view into it. We have not really seen a meaningful impact on trade, but I think that is somewhat a function, again, of our increased focus on being that last stop of basically goods or retailer and business to the consumer. We don't have as much insight as Brad would in terms of what's all happening kind of behind that before it gets there.